So welcome to all of you. And in the tradition of Professor Edwards, good morning, good afternoon, good evening, wherever you are. Welcome to our virtual discussion on COVID-19 and its impact on energy markets and clean energy adoption. I'm Jerry Nicholsberg, Faculty Director of the UCLA Anderson Forecast, and I'll be moderating today's webinar. The panel discussion today is part of the Center for Global Management's special COVID-19 World Discussion Series. Today's session is jointly sponsored by the UCLA Anderson Forecast and the Energy Management Group of Anderson. I would like to thank Lucy Allard and Laura Richardson for their efforts in putting a fantastic program together for you today. So let's begin with our panel. We are very fortunate to have an outstanding panel of experts to talk about energy markets and how they have interacted with this recession and what a post-COVID-19 pandemic landscape will look like. Of course, energy runs the economy, so it has deep implications for the nature of work and economic growth in the coming years. To be sure, energy markets is a broad term. Oil and gas is different from power generation in fundamental ways. Airplanes, for example, run on jet fuel, as indeed the vast majority of our transportation system is dependent upon petroleum. And while oil and gas are substitutes in power generation, substitutes for renewables, they're not perfect substitutes, and they both have separate markets where substitution is not possible at this time. So what happens in one set of markets is going to affect the other set of markets, but that's going to be through spillover effects. And we're going to try and cover this entire landscape today, which is a big landscape, and we only have 1 hour to do that. But please keep in mind the complexity of these markets and how they are not all one market. So I think, maybe we'll start with petroleum and gas markets because they seem to have collapsed as the COVID-19 pandemic swept the world, and get kind of a picture of the background there. And with us today is Dr. Agnia Grigas. She is an energy and political risk expert. She specializes in energy and foreign policy of the US and Eurasia, including Europe, Russia, and China, and author of 3 critically acclaimed books and frequent media contributor. She also has 15 years of experience working with and consulting in the public and private sectors, and is a non-resident senior fellow at the Atlantic Council. So let's turn to Agnia and ask, what is the background here in petroleum markets, the geopolitical background? Started with Russia and Saudi Arabia competing, and then they came to a deal, but prices still fell. The US joined in to support the price, but seemingly to no avail. And at one point, even futures prices went negative. What is the geopolitical background here, and is this just a temporary phenomenon, or are petroleum politics going to be the wave of post-pandemic future? So let me turn it over to you, Agnia.
Yes. Well, thank you. First, it's a pleasure to be here today with you. And when we think about what's going on in the global energy markets today, I think it's first important to distinguish the more immediate effects of the pandemic and the longer term impact and the more structural shift we have been experiencing. So really since March, and particularly since April, we have had kind of a decimation of the of global oil demand and overall demand for fossil fuels. We've also had a dramatic drop in oil prices, at one point with futures even going to negative. And people have been calling it Black Friday now in terms of its impact. And we saw countries at that time in early April, like Russia and OPEC, trying to make a deal in order to stabilize, to prop up prices, and to prop up prices by cutting their production. And we even saw the United States coming into the mix, coming into this deal. Now, when we try to understand how the US, first of all, came into this picture and into this company, we have to look a little bit back. And really, I'd like to pinpoint the structural shift that I think has been occurring over the last 10 years in the energy markets, really since the shale boom and since the United States became a leading oil and gas producer in the world. the United States today is a leading oil and gas producer, and it has come, into head-to-head competition with traditional producers such as OPEC, Saudi, and Russia. So with the U.S. coming into the markets with the shale boom, we've had a boost, a dramatic increase in global energy supply, particularly in oil and gas that has been derived from fracking and from shale production. And this already occurred before COVID-19. So there was already this, what analysts were discussing, peak demand. And there was already a buyer's market and prices were already going down. And there was already an interplay and a shift between the different players, the traditional producers like Russia and Saudi Arabia, and the new energy superpower, the United States. So I argue that COVID-19 and the last 3 months has only exacerbated the ongoing trends we had been experiencing in the last 10 years and especially in the last 5 years. And therefore, we have to expect a similar type of framework in the energy markets, both from a market perspective and from a geopolitical perspective in the post-pandemic era. Again, an overabundance of supply, lower demand, lower energy prices, and of course, greater geopolitical competition between the United States and its energy sector and ambitions, between Russia, which is trying very aggressively to hold on to its position in the global energy markets, and of course, petrostates like Saudi Arabia and others, which will have to work hard to maintain their economies and societies as they face these dramatic shifts.
Thank you. And I do want to come back to that issue about geopolitical stability and what that means for the world economy. But let's explore this price issue a little more. So our second panelist is Mr. Tom Georgis. He's CEO of SolarReserve with over 20 years of development and operational experience in energy technology and the government service sector. His experience includes structuring transactions for energy and infrastructure projects, negotiating with lenders, and advising investors in all aspects of energy project acquisition and project development, including storage and transportation, capacity sales, gas and alternative fuel power generation, and so on. He also served 9 years as a Naval Special Warfare officer in the United States Navy, is a 98 Anderson MBA, and a member of the Board of Advisors of the Price Center for Entrepreneurship and Innovation. So Tom, welcome. Welcome back to UCLA. And it's usually the case when petroleum is inexpensive and natural gas is inexpensive that consumers and businesses and utilities will shift away from both coal and renewables towards petroleum-based fuels. And of course, the drop in demand for coal-fired electrical plants really accelerates kind of the end of coal as a fuel. But what about renewables? Does the American consumer now go to urban assault vehicles? Do the movement of utilities towards renewables, even though the cost of renewables has gone down, now shift back to natural gas? What are your thoughts about how this collapse in petroleum prices spills over into to renewables and power generation?
Thank you, Jerry. And again, appreciate the opportunity to participate on today's panel. Certainly a very interesting topic. Probably should bifurcate a little bit your question and talk about what Agnia was discussing, the impact on low fossil fuel petroleum products on, let's say, the automotive industry, and then also talk a little bit about the low cost of natural gas on the power generation mix and the impact on the renewable energy sector. It is important to step back and look at the pre-COVID trends. And obviously, renewable energy penetration not only here in the United States, but globally, has been dramatic over the last 10 years. There was the news report yesterday that renewable energy, for the first time in 130 years, I'm assuming 130 years ago it was hydro, surpassed coal-fired generation in the United States. And certainly, that trend will continue post-COVID crisis. There's massive pipelines of wind, PV, hydrogen, battery storage, et cetera. And those trends will continue, driven by two factors. One is price. Certainly the price of wind power, of solar power has dropped and will continue to decline going forward. But also policy, despite, I'll say, the clawback with the current administration in the United States, the overall trend, both here in the US and globally, driven by policy, whether it's renewable energy targets, other legislative mandates, or in the capital markets, what we see with ESG, pressure for renewable energy to be deployed. And so I think it's a combination of those factors. We'll see that trend continue post the COVID crisis. Certainly in the near term, we've seen the price of electricity drop dramatically because consumption has dropped. We've seen the price of gasoline drop dramatically because the price of oil has dropped dramatically. But whether or not we see in the automotive industry a dramatic shift, or with customers, we see a dramatic shift from an emphasis on fuel efficiency or electric vehicles, and will everyone run out and buy big SUVs because gasoline is so inexpensive? I doubt that's going to happen. These are very slow-moving markets with respect to, again, long-term trends. To go from building electric vehicles to large SUVs, I think from a strategic planning standpoint, those decisions are already being made or have been made. In the European Union, it's anticipated that electric vehicles are still on track to be 40% of the market by 2030. And so you're not going to see Audi and BMW and Mercedes shifting to SUVs at the expense of their electric vehicle programs. I think that trend is going to continue. And certainly customer behavior has been shifting during the crisis. Obviously, the stay-at-home mandate, no one's out there driving their vehicles. That's continuing to suppress the price of gasoline. The consumption or the purchase of bicycles, has increased dramatically during the crisis. Whether or not we see that trend continuing, that'll be interesting to take a look at. But I think, during the crisis, everything has been suppressed. But there will be a continued appetite, once the economy start opening up, once the impacts of this current recession start to abate, then you'll see an increase in demand and obviously the subsequent increase in supply. But I think, again, these long-term trends, there'll be some dips and there'll be some short-term impacts, but I think the overall trends are going to continue as they had been pre-COVID crisis.
Great, thank you. So turning now to finance and investment. Our third panelist is Mr. Jason Lee. He's Managing Director and Co-Portfolio Manager at Oaktree Capital Management, Chairman of the Board of Array Technologies and Riggs Distler, and specializes in investment in the energy sector, particularly in renewables and utilities. Jason's also a faculty member here at Anderson, teaching courses on finance and entrepreneurship, and a 2007 MBA. So Jason, now turning to the investor, where does this leave them? As the economy grows, the demand for energy will certainly grow with it, but how do we think about the post-COVID-19 pandemic energy markets and where the opportunities might be, particularly given how low energy prices are today and the impending bankruptcy of many exploration, drilling, and power generation companies? Is there an opportunity for superior returns in this low rate of return environment today, or is it going to take some creativity?
Well, thanks, Jerry. And thanks everyone for joining, and thanks also for giving me the hardest question. I think not to be facetious, but I think that sort of our view is that in any environment, there's an opportunity to make good returns on investments. And certainly in this kind of environment, there are more challenges like underwriting projections and the near-term forecasts, a lot of wild cards in the near and the longer term. But it's really in this kind of market where there's a broad sell-off, throwing kind of the baby out with the bathwater is where we find often good bargains for investment. So there's certain, even within the oil and gas space, we tend to focus on the midstream and the downstream because the upstream generally has more direct commodity exposure. But even there, we think that there's been kind of a broader over-sell-off, and you can find companies that, again, have been unfairly penalized. And as I think you mentioned, as long as there's humanity, we're going to need energy, we're going to need light, heat, cooling. And so these companies and industries will persist. More specifically, I'll sort of build on what Tom said, which is we, within our group, we tend to be more power-centric in our investing. And we are long-term believers in renewables, and we have been for a long time. And I'll say that there have been some landmines, even within the renewable industry, that you've had to navigate. And we tend to be most bullish on utility scale renewables, both solar and wind. And so we're looking for opportunities now to continue to invest in those sectors because we believe that, as Tom mentioned, that things will kind of turn back to normal, that there may be more of a delay in the implementation of certain projects due to supply chain issues or construction site access issues. To some extent, the cost of capital has increased somewhat. But in particular on the utility side, these are multi-year, if not decade-plus capital investment cycles. And there's a very large backlog of projects in pipeline that we believe will continue. So it's a matter of finding companies and sectors and subsectors that will really survive this. And I think it's a matter of structuring investments in a way to ensure that you have enough liquidity to get through the chasm of a potential cycle. But we're looking for investments now. We're actually very actively investing now in companies that, again, address the sort of the increasing penetration of renewables, primarily on the utility scale, to some extent in the commercial. And then also even kind of the fossil generation and existing transmission distribution infrastructure is also very important. We're not going to disappear, or coal has largely declined in terms of the generation mix, but it won't disappear overnight. And we also need the wires and the substations and the infrastructure to deliver all these electrons as well. And there's been chronic underinvestment. And so that's another area where we find, regardless of the pandemic and the cycle, opportunities to invest.
So let's see, do we have any? We don't have any questions yet, so please use Slido and enter your questions, but I have a bunch of them. And so I'd like to follow on that, Jason, and thank you for your remarks. But when we talk about power generation and the geopolitics of energy, it seems, at least based on the rhetoric that we see, not just in the United States, but around the world, there is a move towards deglobalization. Now, China is a large producer of wind turbines and of solar panels and of the capital inputs to renewables. If we, the United States, designate those as being critical national security items, but we don't really produce them in any large quantities, what does that do to both the price of renewables, the economics of that, and the way in which this trade goes forward, and the resulting price of natural gas fueled power generation. What are your thoughts on that?
I think it's a great question. And we saw an example of that with what we call the Section 201 tariffs on imported solar modules and cells. And that had an immediate impact on the cost of imported cells and panels, largely from China, with an immediate tariff of 30%, ratcheting down 5% each year. So I think we're maybe in the 25 or 20% zone now. And that did have an impact in terms of the installation, primarily on the commercial and residential sides. The economics, again, for utility scale tend to be a bit more attractive and resilient. So it's definitely had an impact. Now, the interesting thing, though, is that the tariff didn't really accomplish, I think, what was intended. And so this tariff action, which was brought by two solar manufacturers, ironically, one whose parent company was a Chinese corporation and the other was a German corporation, actually today are not making modules anymore. In fact, one went into bankruptcy and the other was acquired by SunPower. And I actually, they're not making modules anymore. And I think it actually sort of the domestic production of cells has actually declined. In fact, it's almost gone now. We do think that the economics, notwithstanding the higher prices due to the tariffs, won't really sort of curtail the adoption of renewables that much. And again, the growth of in particular utility scale solar, even post tariffs, has been very, very strong. And so, and I think that, for example, one of the companies that I oversee, which manufactures a key component in solar farms, which previously sourced a good portion of its inputs from China, very quickly, within a matter of a few months, retooled its supply chain to actually source the same products from other places like Korea and Vietnam, which actually were not sort of impacted by the tariffs. So I think there'll be a lot of innovation in terms of supply chain, a diversification of procurement, obviously investment in domestic manufacturing. And I think that the industry will nimbly kind of navigate whatever sort of policy impacts that may manifest in the future.
Tom, your thoughts?
Yeah, I would agree with Jason's assessment on, I'll say, the tariffs on the pricing of components, but I don't think that's necessarily been reflected in the price of electricity. So when we talk about the broader market and what you pay as a customer in cents per kilowatt hour, and the pricing that we're seeing on power purchase agreements that are being awarded from utilities, and again, we're talking utility scale here. I'll defer to Jason on the distributed generation and on the household markets. But on the utility scale markets, I don't think there was any impact. And there was an impact on the returns that investors received, but it's been I'll say a highly competitive market. And so there are investors, there are energy companies that are willing to accept a lower return, and they adjusted the return requirement rather than be deemed uncompetitive because they submitted a higher price bid or offering into a tender process because a PV panel happened to be a little more expensive because of this tariff. But, as I said, I agree that, there may be a temporary implication, but the longer term trend is that, the price of wind turbines, the price of PV panels, the price of battery storage will continue to decline due to either scale or innovation. PV panels are becoming more efficient. Battery storage, whether it's lithium ion or newer technologies, are becoming more efficient, less expensive. And I think those trends are going to continue. So yes, there will be some very short duration implications, but I think the broader both capital market perspective and legislative or governmental perspective, is that the policies are going to be favorable for renewable energy going forward, not just here in the U.S. I mean, SolarReserve was very active in a number of global markets, and it was very much a global trend as opposed to a U.S. focused trend, although the U.S. is obviously one of the larger renewable energy markets. So, yeah, I think that's kind of where I would leave that point.
Yeah, Agnia?
Yes, I'd like to come back to the issue you raised of this potential deglobalization of the energy markets. Because we've had a global oil market for nearly 100 years. And in my last book, actually, I'll do The New Geopolitics of Natural Gas, I was arguing that we're really on the cusp of a global gas market. And a trend that has been continuing for the last 10 years or so. But really, what we've also seen now during the period of rising geopolitical competition with China, Russia, the OPEC countries, and also in the pandemic era, we've seen somewhat of a fragmentation and regionalization of energy markets as well. And we see that really in the price differentials that have been apparent since April between the West Texas intermediary pricing and the Brent pricing for crude oil, which has lasted for a couple of months, and the price difference being in the about $10 range, quite noticeable. And a lot of this is also driven not only by current immediate conditions of the pandemic or political tensions, but also in infrastructural issues. I mean, especially in the fossil fuel industry, I mean, infrastructure is a very significant element. And with the U.S. emerging as a leading oil and gas producer, it has still maintained some bottlenecks in terms of its exports and even domestic movement of oil and gas. So I think this is an interesting area to watch. To what extent we'll continue to see kind of hindrances towards a global oil market or a global gas market, and to what extent we may actually see a reverse trend of more regionalization of energy markets.
Great, thank you. So Charlotte has asked a popular question. How do you think future federal stimulus packages in response to the recession, and we can think about this also, European stimulus packages and Asian stimulus packages. In response to the recession could impact the renewables industry. So, and there was an economist article this week on that, using kind of the language of the pandemic about flattening the curve of moving towards renewables and combating climate change. So what are your thoughts about the stimulus packages in the US and maybe worldwide, and how they might be affecting the market for renewables?
Well, Jerry, I guess I could start. I think that the renewables industry is not dependent on stimulus. That I think the economics, especially at the utility scale, are already compelling. They're at parity or more competitive than, let's say, a combined cycle new gas plant, for example, which typically sets the standard. So even without subsidies, to Tom's point, the cost per watt of wind or solar energy has come down due to increased efficiencies and just generally decreased costs. And so I don't think it's stimulus dependent. However, I think that the pace of adoption will be deeper and faster with more stimulus. And for example, probably one of the most impactful incentives that the industry has seen has been tax credits. So production tax credits and investment tax credits have really driven the adoption of solar and wind when prices were a lot higher. And it really accomplished its mission. It wasn't sort of intended to be a permanent subsidy, but really to get to a point of adoption where economies of scale, technological innovation, drive down the cost per watt and make it stand on its own 2 feet. And we're there now. So I think this is also largely dependent on the wild card of the November elections. As an example, I don't think it's a secret that the current administration is not necessarily big fans of renewables or energy efficiency. And in fact, when the administration gave the 3-month tariff relief, they actually carved out solar panels. So depending on, I guess, what happens in November, I think there could be significant shifts in support for renewables or not. But also a bipartisan issue, I think, also is infrastructure spending. And so that's another area where we think that depending on where those infrastructure dollars go and how big that pool is, there could be significant sort of tailwinds generated for the renewable industry.
So we have another question here, and this has to do with emerging markets. So when we think about, for example, India is a fast-growing economy, but it's also pollution has been fast-growing as well. And the argument has often been made that well, the first thing you have to do is raise standards of living, and then you can worry about pollution. Certainly China has made this argument for years and is now starting to be a little more serious about pollution abatement in the face of climate change. When we get past the current recession and start growing, and these emerging economies around the world start growing faster than the developed world, do you see the current pandemic, the evidence of people not driving and factories not operating and skies becoming blue again, causing a shift in the demand for renewables and for electric vehicles? Or do you think this is more a temporary phenomenon, and in that sense we go back to business as usual? Who would like to take that? Agnia.
I can jump in to start. First of all, we've been already seeing a shift in perspective in India and China for a while in terms of the implications on society of pollution. I think in China, it was even perceived as a potential cause of even social political instability because pollution was such a sensitive issue for the public. And the same, similar thinking had started to grow in India as well. And that's why both of these countries had also looked very aggressively towards boosting their use of natural gas as a kind of cleaner fossil fuel, but also looking towards the future and also looking towards renewables. So I definitely think this trend is here to stay. I think probably natural gas will be that transition fuel for both India and China, but I think they will both also aggressively look towards renewables as they take that next step in kind of their meeting their energy demand, which again is vast. And at the same time balancing it with the population's concerns.
Tom, do you have thoughts on that?
Yeah, I would agree. I've spent a lot of time in China. Renewable energy has been an integral part of their 5-year plans with respect to their energy generation mix. Obviously, from a manufacturing perspective, for both the domestic and the international markets, wind turbines, PV panels, as we discussed previously, have become a critical part of their economy. When it comes to battery storage, electric vehicles, alternative fuels, China is at the forefront of almost all of those technologies, both from an innovation, but also from a scale perspective. And as you correctly point out, the Chinese government has started to recognize not only the health implications, but also the costs of pollution, and are making the requisite adjustments to try to address that issue. India is a little more challenging. It's obviously not a centralized economy or government. But as we've been discussing, the price of renewable energy or the cost of renewable energy is becoming very attractive. The challenge is that in both India and China, the cost of coal and the existence of an extensive fleet of coal-fired generation facilities will be difficult to displace. But I think as they continue to grow their economies and the population continues to grow, there will be a consistent upward trend for the demand of electricity. And I think that will be met during this transition phase, but also going forward with renewable energy. I think the bigger threat is going to be from transportation. So as the middle class expands in both China and India, and every family has one or two vehicles, if those are combustion engines, then that'll be problematic when it comes to pollution going forward. But as I said, I think both countries are going to be very innovative when it comes to electric vehicles, but that will require an extensive infrastructure play with respect to charging stations. And then again, it's the idea of how do you look at the metrics of an electric vehicle if it's being charged from coal-fired generation. And a few years ago, there was an interesting study by Tesla around that in China, where the Tesla vehicle was actually more polluting than a conventional combustion engine because it was coal-fired, produced electricity. But again, I think one of the, I hate to say a benefit of this COVID crisis is that, they are starting to see with an almost 17% reduction in CO2 and greenhouse gas emissions, the possibility of what can happen if there is dramatic curtailment in power generation or transportation usage of combustion engines. So hopefully that will have a beneficial impact. And, again, as we look at these stimulus plans or what they're calling a green recovery, to the extent that the Indian government and the Chinese government will follow the lead of countries or entities like the European Union, that could be, again, a way to accelerate the deployment or the adoption of more innovative clean tech technologies.
Yeah, so there have been a number of questions related to infrastructure, and Jason, you spoke about this a little bit in your opening remarks. Renewables require a whole different infrastructure, different grid, different storage technologies and the like. Do you see the investment in that accelerating in such a way that there can be an acceleration of a move to renewables in the US and elsewhere in the world?
I think so. I think the challenge is who's going to pay for that infrastructure. And so one sort of debate that's been going on for quite some time now between owners of renewable assets and the utilities who are responsible for maintaining the electric infrastructure. And by the way, the utilities are becoming the largest owners of renewable assets as well. But there's been an ongoing debate as to whether the consumers of renewable energy, whether it's a residential consumer or commercial consumer or otherwise, should be paying some sort of a tax for basically delivering their electrons over the utility infrastructure, because the utilities have had to maintain the wires and the substations and transformers, but they have an obligation to allow renewable generation to ride along that infrastructure, but they feel like they're bearing all the costs, losing market share, and really the renewable generators are getting a free ride. So there's a sort of a tension there, and that relates to things that I'm sure everyone's heard of, like net metering, which is another issue. So I think to answer your question, I think the infrastructure necessary for increased adoption of renewables is I think will happen. We've seen, again, new transmission lines be built. We've seen infrastructure be upgraded. But apart from renewables, I'd say that the electric infrastructure in the United States as a whole is highly underinvested. And there will need to be a lot of investment generally in that infrastructure. Case in point, we're sitting here in California, and we've had a lot of issues with wildfires that essentially bankrupted one of the largest utilities in the country. And there will be tremendous amounts of investments that utilities will need to make to secure the infrastructure, prevent fires, prevent security breaches. And so just generally on the topic of energy sector investment as it pertains to power, it will be enormous for the foreseeable future.
So a good place to look for opportunities to invest.
Absolutely.
So investment always involves risk, and we've got a few questions around risk, including the impact of potential nationalization of petroleum and of power generation, and the impact of that on investments, as well as risks such as infrastructure and disruption in international energy markets. So how do you all think about risk in this environment and what that risk portfolio is going to look like in a post-COVID-19 pandemic world, as opposed to the one that we've just come up through the end of 2019? So that's kind of a broad question. Who would like to jump in first? Tom, you're smiling, so.
Well, yes. In any market, what investors, what executive teams are looking for is certainty around policy. And so, in many markets where we've been active in developing renewable energy projects, that's been a challenge for us, is what is the policy, whether it's a tax policy, whether or not there are mandates on a percentage of renewable energy being part of the overall generation portfolio. Is there a carbon tax? Is there a price for carbon? Are there going to be stimulus packages or green recovery post-COVID? What will that do to the overall market? We haven't fortunately had to face any nationalization type issues, but it's that uncertainty that plays into the overall risk assessment on whether or not, you enter into a new market, an emerging market like India or like South Africa. We have opportunities in South Africa, and what's on the table is they have a state-owned utility called Eskom, and there's plans to do just the opposite, is to privatize and break it up into generation, transmission, distribution, and then other aspects of an energy company. And so that'll have huge ramifications for the energy sector in South Africa, as an example. So, of course, like I said, as an investor or as an analyst or as an executive, you're always weighing the pros and cons of doing business. And even here in the United States, on a state-by-state basis, we don't have a comprehensive energy policy or a national energy policy. So it really does differ on a state-by-state, as we're seeing, the response to the COVID crisis is being handled on a state-by-state basis. And so, those are certainly, again, key considerations on where you do business and how you do business. And obviously this current crisis adds a new level of risk into the overall assessment that everyone has to perform.
Yeah, so Agnia, how does this all kind of play out, particularly as many petroleum producers are developing or emerging economies and don't have as stable governments as you find in Europe or the United States or Japan? What does that do to the international risk?
There's a lot of global risk right now, particularly stemming from the energy markets, but also because of the nature of the states involved. first of all, a lot of the petrostates have been experiencing significant pressure now for some time. If we look at the smaller petrostates, like Algeria, Iran, Nigeria, Kazakhstan, Venezuela, okay, they've been facing some, deep societal, economic, and political issues already before COVID-19, already before their revenues were decimated. If we look at, even the larger petrostates, Saudi Arabia, more than 80% of its budget was dependent on oil sales. Of course, they've had a dramatic impact with the Crown Prince, also Mohammed bin Salman, who's been trying to keep a lid on this kind of young and restless, but at the same time this drop in energy prices and drop in energy demand has even put a lid on some of President Vladimir Putin's ambitions to pursue constitutional changes, so he'd be able to run for another presidential term. So these constitutional changes have been postponed, in part because of the pandemic, but also because of the economic impact Russia has been feeling. And again, if Russia, more than half of its budget is met with oil sales. Even more if you count in other fossil fuels. So I think in these countries where energy companies are owned by the state or controlled by the state to a great degree, we will see more risk. But I would also not exclude changes in the US, and especially the impact this will have on our shale industry, because the US shale industry has really been grown from small independent producers. And that's very interesting and very different if you compare it to the global context. In the United States, small and independent producers account for 83% of America's oil production and more than 90% for its natural gas production and natural liquid gases. So in this regard, these smaller producers have been much more vulnerable to the price drops that we've experienced in the price and demand. And there's potential that this industry will also see bankruptcies, realignments, consolidations, or they will be pushed to innovate further, be even more agile, even more innovative. So I think these changes will have certainly an impact on the petrostates and their stability, but this will also have a market risks in the United States for a shale industry.
So kind of continuing on that, we, prior to this pandemic, we have seen worldwide, particularly in the EU, but lots of discussion in the US about a carbon tax. What does the pandemic and the collapse in petroleum prices and kind of the current environment tell us about whether or not a carbon tax will go through, and if one does, for example, in the EU, how that impacts energy markets, both power generation markets and fossil fuel markets? Any thoughts on that? Anyone want to take that?
I can touch on it. I think energy policies will be so driven by local conditions, and these will be state choices. And to a degree, we've seen even Germany, like the city of Berlin, take their own policy choices. Like also we've seen in Los Angeles, let's say maybe a more ambitious renewables policy than elsewhere in the United States. I wonder to what degree the potential economic recession will put a dent in some of these more ambitious plans. We have to remember also not too long ago the yellow vest protests in France with the working class that was struggling with Macron's introduced specifically, the carbon taxes and tariffs on fossil fuels, the economic impact it was having on them. And I wonder, again, given the looming recession, how many leaders would be willing to take those types of steps?
Yeah, it's, it's what we economists like to call the elasticity of demand, and that's very much localized, right? We may have a different view here in Los Angeles or in San Francisco than in Caracas or Lagos, right?
Right.
So we are kind of running out of time, and I did want to ask a question. I know I have more questions coming in on Slido, but I did want to ask a question of each of you. So you can choose who goes first, but our students are looking at what are going to be the really lucrative, interesting, intellectually challenging career paths to follow. And each of you have experienced really successful careers related to the energy sectors, plural. So the question I want to ask is, what advice would you give our students coming out with their MBAs in 2020, 2021, 2022? Who would like to start? No one's jumping forward. Jason.
I can start. And I'll answer it from the lens of energy, given sort of the topic du jour. I think that, so using myself as a personal example, when I completed my MBA, I had an intention to actually get on the investing side. I used to be an investment banker and entrepreneur, and I wanted to help companies grow and increase value, and private equity was really my sort of option. I did not intend on being an energy private equity investor, but that's what I've been for the last 13 years and change, and it's been very interesting. As an example, when I first joined the group that I'm with, we were looking at investments really based on the assumption of new coal generation. And boy, did that change very quickly. And so, as I said before, energy is something that we'll need as humanity, as a society, really forevermore. And the forms of energy and the composition and the technology for delivering and generating that energy will change. But there will always be opportunities in this industry. And for MBAs in particular, I would suggest, obviously I'm biased, but looking on the investing side, whether it's in private equity, investing in established businesses, whether it's venture capital, investing in the innovation behind new materials and batteries and storage and other technologies. It could be on the project finance side, whether it's tax equity or other sorts of project finance or infrastructure finance. Or I think there are numerous opportunities for well-trained managers in operating companies. So when we make an investment in a business, one of the hardest, sort of most important aspects of our underwriting and due diligence, and also one of the hardest things to actually, resources to procure, is actually talent. And so, again, I think there are just a plethora of opportunities, notwithstanding the uncertainties in the current environment.
Tom?
Yes, I have an operator background in the energy sector, but also have been part of clean tech startups. And so I think given this crisis and given how dynamic both the power sector is and the transportation sector is, there's tremendous opportunity for innovative technologies that will affect the global energy markets, all encompassing. Similar to Jason, I have a comparable anecdote. Back in 2003, I was working on the development of an LNG importation facility in California. And obviously the natural gas markets, as the result of fracking and shale gas, changed dramatically. And so companies like Cheniere that were building importation facilities, regasification facilities, flipped their business model to liquefaction and the export of natural gas. And so these markets are very dynamic. They change constantly. As Jason mentioned earlier, the utility model that's been around for hundreds of years is changing. Distributed generation, using your Tesla as your home storage or battery to run, your your washing machine or your TV, having real-time pricing or access to wholesale markets as a retail customer, having a smart home. All of those things are affecting, the traditional view of the energy market. And so I think, there is tremendous opportunity for MBAs to be a part of what used to be considered a very stoic market, that wasn't very dynamic, that wasn't very innovative. I think that over the last 10 years, we've seen that that's no longer the case. And so, I would highly encourage, graduating MBAs to take a look at the energy sector, because I do think there's tremendous opportunities there, whether or not you want to be an entrepreneur, whether or not you want to work for an established utility, whether or not you want to be an operator, or you want to be on the investment side. There's a very broad gamut of opportunity.
Agnia.
From my perspective, I think what attracted me initially to the energy sector is, really because it combines both economics and business, but also politics and policy. In the energy sector, you have to have you have always local considerations, national considerations, and global considerations. So I think from that regard, it's a very exciting field. And I think with someone who maybe has an interest in policy, in politics, in global affairs, it's also in a very exciting field where you can bring, broader perspectives and combine those different interests.
Thank you. And it looks like we are out of time, which is Thank you. And it looks like we are out of time, which is unfortunate because we could certainly go on for much longer. And I think y'all are right. This is a real dynamic, fast-changing, interesting field, plenty of opportunities as we go forward from this pandemic into the next expansion. So many thanks, Agnia, Tom, Jason, for joining us today. We really appreciate your insights. Thanks to all of our attendees. And my apologies that we couldn't get to all of the questions, but hopefully we got at least a significant portion of them asked. So thanks once again, and have a wonderful rest of your day.